Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Welcome to On the Brink. I'm Matt Walsh.
And I'm Nick Carter. And
this episode is brought to you by Coin Metrics. And here is the Metrics Minute. I guess it's a Metrics 15 minutes.
Yeah, we are welcoming Kyle onto the show later to talk about the merge. As an appetizer to that, we're going to do the Metrics Minute also.
Oh, we got both. Two for the price of one.
Yeah, we're doing two. So, as you all know, the merge is happening. I think it's scheduled for the 16th of this month. So Ethereum will transition from proof of work to proof of stake. After the merge, the issuance will be dynamic, increasing as the amount of staked ETH increases, and also decreasing with burns, which is a function of the usage of Ethereum. Coinmetrics figures that a typical validator will earn returns of around 4.5% per year. And that would increase with more transaction fees and MEV. We do talk to Kyle Waters later in the episode, so we'll deep dive in on that. That's your Metrics Minute.
What time is the merge on the 16th?
We don't know exactly because it's in block time as opposed to clock time. So
what's the latest guess?
We think it's in the evening. We think it's kind of like 10 p.m. Eastern time. So
10 p.m. on a Friday, there's big parties.
Well, yeah, I mean, some people are going to be out and some people are going to be watching the blockchain. I know which camp I'm in.
I'll be watching the blockchain.
Yeah, that's what we do over here. Coinmetrics told me they're going to do a live stream, so we're going to have kind of like a live merge watch party.
Are they going to have like a meetup?
I don't know, but we're going to be looking at analytics. We're going to watch the blocks roll in. I don't know if anything's like, is there even anything to look at? Like a block explorer? What are we going to watch?
Yeah, I think you watch a block explorer. I mean, historically, I would probably watch like the trade block explorer.
You're really going to have to just imagine all the GPUs powering down all at once. It's like, in Star Wars where they blow up the planet and they're like, that was the sound of, I'm butchering this, whatever, a million souls, crying out at once and vanishing, whatever the line is. You all know the quote. Now it's the same. Like, you're going to have to imagine a million GPUs coming to a screeching halt all at the same time. It's tragic.
So what do you think is going to happen to Ethereum Classic? Do you think Ethereum Classic is going to see an uptick in hash rate?
It has been. That's actually in the Coinmetrics report, which we're going to put in the show notes. But there's also no real reason anyone would use Ethereum Classic. There's no DeFi on there. There's no stable coins. So I don't think it's enough of a thesis just to be like, well, the GPUs have to go somewhere. Like, maybe GPUs prices are just going to fall and the gamers will get the GPUs again.
They'll finally get them back. Yeah, gamers. They don't like those Ethereum miners.
They hated crypto for so long. We've really, been troubling them for almost a decade now because Bitcoin and then Ethereum. And so the gamers have been totally colonized by crypto, hiking GPU prices. Now they're finally getting one back over us. So congrats to the gamers.
It's the biggest software upgrade I think I've ever been a part of here. It's exciting. We'll do a couple episodes on this heading into the merge.
Are you getting Super Bowl Sunday vibes or are you getting Y2K vibes from the merge? Because I'm getting
Super Bowl Sunday vibes. I'm feeling like this is going to be successful.
As the TikTokers say, it's giving Y2K. I'm feeling Y2K about it. I wasn't really aware at the time of Y2K, I feel like this is what it was like. I think something unexpected could break. I don't want to be spreading FUD, but that's how I really think something can break that we can't predict.
Well, when Y2K happened, I was ready for it, but pretty uneventful, I would say.
Did anything actually, did like planes fall out of the sky or like nuclear reactors stop working? Was there anything?
It was pretty uneventful, at least in my world. The clock stayed on. Everything still worked.
Okay, because I don't know. I feel like there was a lot of unwarranted fear. This time around, everybody thinks it's going to go great. And so it could be the opposite, where there's unexpected bad stuff that happens, basically.
I will say this. If the Ethereum devs pull this off, which I have every reason to believe they will, you got to give them big kudos. The scope of this upgrade is unbelievable.
Yeah, I mean, one thing I will say is, the hardcore Bitcoiners have long doubted this would be possible. And it is definitely a blow to that narrative if Ethereum is able to do this. I mean,
oh yeah, I mean, Bitcoin would never be able to do this. The Bitcoin engineering army, 0% chance could pull something like this off.
No, and that's not in the Bitcoin design philosophy, but it's there has been this claim that Ethereum would never achieve the move to proof of stake. I'm not saying proof of stake is even desirable. Frankly, I wrote a hit piece against proof of stake this week.
You did.
So I'd piss off the Ethereums that, I think that's a great position to be in where both sides hate you. That's, I feel very comfy there.
I don't know if that's always a great position.
Just to be universally reviled. But yeah, I mean, this is undeniably a win for Ethereum. I mean, they will have done the transition and then they'll be free to, throw those ESG barbs over at Bitcoin. I don't know if they plan on doing that. I hope not. But I
don't know how that whole narrative is going to work out with the German energy. I'm not sure that that's going to be as powerful a narrative.
I mean, I hope that Ethereans are gracious and don't suddenly adopt Ripple tactics. That would be disappointing if they did.
Avalanche tactics.
Yeah, we have a lot to get into. A lot of intrigue. I mean, it's really bear market blues these days. The infighting is significant and aggressive.
Oh yeah, when the bear market comes out, you just get in a firing squad. You form a circle, and then you start to fire. It's a circular firing squad right now.
Yeah, we felt it. The Bitcoiners are upset. Ethereans, also lots of drama in Ethereum space, and then outside of that. Sort of a major L1 land, significant amounts of drama. We'll get into it.
And before we do, you had a good podcast this week. Direct people to that. The founder of Fedi was on talking about Bitcoin custody.
Yeah. So I know, we get accused of defecting from Bitcoin. We're still here. We're still doing Bitcoin shows. So Obi Nwosu, great guy. He ran CoinFloor, which was the longest running proof of reserve attesting exchange. So I think they did proof of reserves monthly for like 7 years. And now he's founded a company devoted to Chaumian mints, federated Chaumian mints on Bitcoin. It's actually like a kind of a new idea, at least in Bitcoin. I've always been in favor of Chaumian mints. I thought that was a great scaling strategy. So yeah, I think that's much better than scaling up through centralized exchanges. So excited for that to potentially be a thing.
What's going on with David Chaum's blockchain? Has that launched yet?
So yeah, Elixir has indeed launched. I think testnet. I don't know if it's testnet or mainnet, but it has launched, which is kind of incredible. And no one's talking about it. And then it's David Chaum.
Is anyone using it? Are people using it?
I don't think so. I mean, I get DMs about it from Elixir enthusiasts. But I mean, isn't that crazy to think about? David Chaum invented so much of the actual cryptography that's used in this industry, and his blockchain is just totally overlooked. People don't have any respect for their elders.
Yeah, it's crazy. I mean, hey, Zuko might have invented Bitcoin, and not a lot of people are using Zcash either.
And that one, we're going to be touching on that later in the episode. But yeah, I think that people in crypto just don't have a strong appreciation for the cypherpunks. I mean, they're not reading their history books here.
Yeah, there's definitely a lot to brush up on. All right, well, why don't we hop into some deals of the week here? First one up is Proof. This is Kevin Rose's company. This is an NFT brand and collective. They've raised $50 million from Andreessen, Collab Fund, 776, True Ventures, and others.
Proof, of course, behind the Moonbirds launch, which was one of the hottest NFT launches of the year.
These guys are kind of getting crushed on the IP stuff. I don't know if you've picked up on that, but Alex Thorne and the Galaxy team have really been identifying some of the weaknesses in the intellectual property protections here. Yeah,
actually, this is really interesting and I think totally overlooked. Alex has been on the total warpath here by pointing out that all these NFT projects basically are, I don't know if fraud is the right word. Frankly, it may be the right word, but basically they're sort of like claiming that they're giving far more in terms of IP protections to holders than they're actually giving. Moonbirds was pretty egregious, to be honest with you. Real talk right now. They said during the sale that holders would have specific assurances regarding the IP. They would have ownership rights. And then after that, they pivoted to a CC0 model where basically there's no ownership and anybody can do whatever they want with the intellectual property. So if you think about what that is, it's kind of like a rug pull where you as the buyer thought you were getting a real entitlement to something and then it was pulled from beneath your feet. So Alex has been on the mark here and very critical of Moonbirds. Frankly, I think it's a reasonable critique.
Yeah, we'll see what happens on that front. Kevin Rose really has a feel for internet culture. Do you remember Dig?
Yeah, I was part of the Dig migration to Reddit back in the day. I think that was in maybe 2010. Yeah.
Awesome site. So it'll be interesting to see what happens here on Proof. Next one up is Solana FM. This is a blockchain explorer. They've raised $4.5 million from SBI, D1 Ventures, Spartan Group, and others.
Then we've got Animoca Brands, which is the big kind of NFT gaming metaverse studio, kind of a behemoth at this point. I mean, I think they're going to be talked about in the same breath as Alameda, FTX, DCG as one of the titans of the crypto industry. They raised $100 million from Temasek and others, and Animoca Brands Japan, a subsidiary, has raised $45 million from MUFG and others.
Big raises there. Next one up is Redstone. This is a DeFi oracle. They've raised $7 million from LemnisCap, Coinbase, Arweave, Blockchain Capital, and others.
Then we've got Lightnet Group. They're a provider of blockchain-based payments infrastructure. They raised $50 million from LDA Capital.
776, which is Alexis Ohanian's venture fund, have decided to raise a $177.6 million fund, and that fund will focus on liquid token investment. So buying the dip on some of these tokens, which seems like a pretty good idea, actually. That's a pretty good idea for a fund, I think.
Next up, we have Token Proof, an NFT security startup. They raised $5 million from Penny Jar Capital and others. Great name for a fund, Penny Jar Capital.
Next is Clockwork. This is a Solana automation network, and they have raised $4 million from Multicoin and Asymmetric.
Then we've got Xterio, a blockchain gaming platform. They raised $40 million from FunPlus, FTX, XPLA, and others.
Next is Bitlivex, and that is all capitalized. That is a crypto options trading platform, and they've raised $50 million from Gem Digital. Pretty aggressive to just capitalize your name.
The whole thing,
like
yeah.
Just all caps. It's like it's screaming at you.
Then we've got Coop with a K. That's an NFT fan engagement platform. They raised $5 million from One Confirmation, Variant, Balaji Srinivasan, and others.
Next is SEI. I think that's how you say it. SEI, a layer 1 blockchain. They've raised $5 million from Multicoin, GSR, Flow Traders, and Hudson River Trading.
50 years from now, I think there's still going to be venture funds backing new layer 1 blockchains. Like, there will never be enough.
Yeah, it's L1 season right now, all over again. People don't realize it.
It is.
Also, just there's tons of L1s getting funded, and there's also just tons of new DeFi primitives emerging. So there's good stuff happening.
I do wonder how many L1s the world needs. I know I've said this before. How many L1s does the world need? 3? How many do we really need? 200?
I don't know. There's just so many things you can't do on blockchains yet. Like, you still can't really have a performant central limit order book on these things. There's going to be L1s that solve this.
I don't know if you need that on the blockchain. But yeah.
I don't know. This fits into this MEV conversation, right? You're going to have a ton of MEV if you just have the AMM model.
So there's actually a lot of interesting pieces of news this week. Should we start with the tax enforcement news from the District of Columbia?
Yeah. So the District of Columbia is suing MicroStrategy and their founder, Michael Saylor, and the AG there, his name is Carl Racine, came out aggressively with the tweet storm. I love these people announcing these things on Twitter now, that they're going after Saylor for avoiding over $25 million in taxes that apparently they're saying that he lived in District of Columbia. And I think people thought he lived in Florida. I think he legally does live in Florida. And they're saying, you owe us some money. That's what that looks like.
Yeah. So he, according to them, he represented that he lived in Florida and Virginia. And apparently he was secretly living in DC. I mean, and obviously Florida has no state income tax, whereas DC has an egregiously high one. And so now they think he basically didn't pay them $25 million in taxes over the years. There's some whistleblower which came forward, which basically enrolled in some formal snitching program. And is entitled to a portion of the reward here, apparently.
That's kind of a convoluted scheme,
I mean, it's like the same thing with SEC whistleblowers, I guess. So this is a Wyoming LLC blew the whistle here. And then you've got, the question I have really is, why on earth would you choose to secretly live in DC if you had a very nice residence in North Beach in Miami? And then I think he has another place. I actually thought it was on the eastern shore of Maryland, but it might be in Virginia. But yeah, like, why on earth would you choose to live in the swamp? I'm an authority on this.
Yeah,
I've lived in both places.
I mean, maybe he just
live in Miami. Come on, it's better.
My guess is, he probably just had like an apartment in DC or something, right?
Yes.
But they're saying that he spent more than 6 months there, I guess.
Yeah, I read the lawsuit. I mean, they're relying on Facebook posts. They're relying on records for his yacht, where his yacht was moored in Georgetown on the Georgetown waterfront. He did a remodel of an apartment there in DC. So we'll see. I mean, I don't know. Like, I've encountered Michael a number of times in Florida, so I can definitely attest to the fact that he lives there at least part of the time. I don't know what the exact accounting is of the days. But yeah, I mean, you have to imagine this is at least partially motivated by the fact that he's such a high profile Bitcoiner. I mean, that's got to be part of it.
100%. Yeah. We're going to find out who that whistleblower is, maybe. And maybe it's someone from like Ava Labs or,
it's Roche. It's Roche Freedman.
It's one of these guys. Well, I don't think 25 million is going to turn Michael Saylor into a forced seller of Bitcoin, if anyone's worried about that.
Right.
So I'm looking at BitcoinTreasuries.net. They have a cost basis of $3.9 billion worth of Bitcoin and trading at about 2.5 billion right now on that's painful, by the way. But Even if they had to pay that $25 million fine, I think they'd be all right.
Twisting the knife, yeah. It is interesting the MicroStrategy is named in this and accused of basically concealing this or having knowledge of this situation and, I guess not doing anything about it. But yeah, people are kind of getting the scale of the numbers a little mixed up here. It is 25 million is the claim. He could sell his auxiliary yacht and satisfy that. Not even the main yacht. So like yacht 2 or yacht 3 and satisfy the claim.
I mean, he probably has some Bitcoin cash. He probably has like forked coins that he hasn't even separated yet. I think he'd be able to.
Yeah, just identify some dust in some old wallets and use that.
So that was a story this week, which shows you what type of a news week it is. The other one that caught my eye was, so Grayscale had a disclosure this week that they have received SEC inquiry into the status of 3 of their trusts. It's the Zcash Trust, the Stellar Trust, and the trust that holds Horizon. It looks like the SEC is beginning to question whether or not those assets might be securities. So that'll be interesting. I mean, if these things are deemed to be securities by the SEC, Grayscale would presumably have to liquidate those things.
Yeah, that would be a mess. Zcash in particular, really structured itself so as to avoid potential securities allegations with the founder reward or whatever you want to call it, sort of being vested over time. I think it was over 4 years. As opposed to just being a quote-unquote pre-mine. So yeah, that would really challenge a lot of the thinking in the industry around how to avoid Howey if it were shown to be a security.
That discount, still a discount. Nothing new to report there. Yeah,
no change. There was an insane story this week, which we have to talk about.
This is the Ava Labs story?
So there's a website called Cryptoleaks. The 2 prior leaks had to do with ICP, Internet Computer, Definity, previously known as Definity. I think it was kind of clear this was a pro-Definity website. And then I think earlier this week, this bombshell article written in like a really tabloidy fashion featuring like secretly recorded videos of Kyle Roche emerged, who's an attorney at a law firm, Roche Freedman. And this is like Project Veritas style secret investigation videos. And basically the interlocutor manages to get Kyle Roche to admit to using basically legal intimidation tactics and pretty questionable stuff against opponents, particularly competing protocols of Ava Labs. And he it appears to get him to admit that he was basically a hired legal gun for Ava in exchange for some share of tokens, some equity in Ava Labs. And so that came out. It was pretty spectacular. It was basically completely denied by Goon, Sear, by Ava Labs. It does appear from a prior lawsuit that Roche Freedman actually does have some share of either equity or tokens. I actually I wouldn't say it's that unusual for law firms to get share of tokens that they are providing outside counsel for. A lot of people say that never happens. That definitely does happen. It definitely happens. The scale was a little shocking. At least it was claimed by the Cryptoleaks crew that Roche Freedman had 1% of the supply of AVAX at some point. So that is kind of a little salacious that this law firm would be granted such a significant share. I think the tactics don't really surprise me. I mean, it's pretty underhanded stuff, but that is pretty common in this industry with scurrilous lawsuits being the norm. The Ava Labs team is basically denying that there was a secret deal here to harass other protocols or get the SEC to focus on these other competing protocols or anything. So they're kind of denying most of the connection there. And the whole thing kind of appears to be potentially orchestrated by this pro-Definity investigative, like Project Veritas style outfit, which is pretty insane. We're really in the thick of it here.
I mean, everyone just looks really bad in this story. There's no way to spin it. I mean, everyone just looks like a complete a-hole.
Cal Roche wrote in his denial that the videos were illegally obtained and highly edited, not presented with context, and they were part of a deliberate scheme to intoxicate and exploit him using leading questions. Goon basically denied everything. Here's like an interesting, funny thing that I found out. This firm, Roche Freedman, was founded by all of the partners were alumni of Boies Schiller, which was the of Theranos fame, where basically David Boies was on the board of Theranos and did exactly this kind of thing for Elizabeth Holmes. I'm not saying it's the exact same situation. All I'm saying is that amused the hell out of me. They learn from the best.
It's interesting. I mean, David Boies has just a phenomenal run as a lawyer, and it's kind of crazy that the thing that he's known for to most people now is that he was on the board of Theranos.
Yeah, no, he definitely intimidated a lot of people that were questioning Elizabeth Holmes. I mean, he was involved in Bush Gore, right?
That's right. Yeah, that's right.
So kind of like legendary lawyer, but then also in that book, Bad Blood, he came across extremely badly.
Yeah, he's represented just a ton of very famous people. Michael Moore, the NFL, some Larry Lessig, it looks like. He's Jerry Jones. Jeffrey Epstein victims. He's been all over the place.
Victims of Jeffrey Epstein, to be clear. But on the flip side, Harvey Weinstein also.
I don't know how we got down this rabbit hole.
He's willing to see the humanity in all of his clients. Anyway, he wasn't directly involved in this, but the Roche Freedman guys are alums of that firm. So just thought that was funny.
That's just a messy story. Hopefully we don't have to talk more about that one. So did you see that the EO, the Biden executive order, they're due, I think, next week. Wonder how that's going to work out.
I mean, I wonder how comprehensive all those reports will be. They didn't really have that long to write them.
No, there wasn't much time. Yeah.
There's a flurry. I don't know how many it was exactly that were requested in the EO, but it was a lot, like more than a dozen, I feel like.
Yeah. I would imagine that there's going to be some recommendations, but I mean, what we really need is just spot market clarity. Who's regulating that spot market?
Yeah, I have a few items on my wish list. Modernized securities regulation would probably be my number one. Basically, the other one would be giving the CFTC control. Basically, give CFTC and marginalize the SEC, if it were up to me.
Well, did you read... So former SEC chairman Jay Clayton, he wrote this Wall Street Journal op-ed this week on crypto assets, and he recommended a bunch of stuff. He recommended that the presidential working group codify stablecoin regulation, which I think they will. And then he recommended that the SEC give clarity on custody of tokenized assets. And I took that to mean a couple things. One is just clarity on like real world securities and things like that. So the custody rule thing and the fact that there's 45, 50 broker dealers in line to get that clarity, but also probably clarity on the Bitcoin and Ethereum front around qualified custody and whether or not these state trusts actually get treated like qualified custodians in the eyes of the SEC. So to be clear, I totally agree with everything he's saying, that we need clarity on those issues. But the underlying current is, why didn't you just do it when you're in the seat? Like, what the heck?
Yeah. I don't like these, come to Jesus moments after they have lost any regulatory sway. What's up with that? Come to Jesus while you still have power. How about that?
I know. It's just so easy to write op-eds when you're retired, but come on, man.
Elsewhere in incomprehensible drama, there's some crazy stuff about Maker. Have you been following this? Maker leadership, Rune in particular, is looking to potentially float DAI, the stablecoin, and turn it into a free floating new unit of account, not tracking the dollar, in order to boost the censorship resistance. So depeg it from the dollar and keep it censor resistant.
I think you have to. I mean, there's no way that they're going to be able to operate Maker DAI at scale the way it is. There's centralization vectors there around USDC. And the concept of going out and buying treasuries, who's actually procuring the treasuries? There are very real points of failure there in that system that will fail. They will 100% fail. And so I think if they go down this path of depegging, let it free float, it's not going to be $1 anymore, clearly. I mean, that much I'm convinced of. But what other alternative do you have?
I mean, this is a very circuitous way to arrive back at Bitcoin. You know, Satoshi talked about this in the year of our Lord 2008. And, you know, the question was, why can't you make Bitcoin stable with respect to dollars, or maybe make it worth $1? And Satoshi's like, well, you need someone to manage that, and you need the system to know what the price of $1 is. And, you know, then Satoshi opted for the free flow. So it's like DAI came all the way back around, and they're like, oh, this is why this is this way. It's like a real Chesterton's fence kind of thing. But the problem is Maker has already embraced the real world asset collateral. They were engaging with banks, like actual banks. They were completely embracing it. So it's a little late, I would say, to take this turn. And so this is by no means something that's guaranteed to happen. There's definitely other factions in the Maker community. I find the Maker debates to be some of the most complex in the whole crypto space, but very telling.
Yeah, they're very complex. I mean, I've been following the Hasu back and forth a little bit. I mean, it's really interesting. Some of the sharpest minds in the space in the Ethereum community are chiming in and going back and forth. So it's really fascinating stuff to read. But yeah, you can always go back. I mean, you can go back, sell the real world assets, get rid of the USDC. You can definitely roll back.
But this was exactly the issue they faced years ago, and I was critical of them. They went from single collateral DAI. Remember, it's just Ether back in the day, so it was very censor resistant. It was all kind of automated, and then you're issuing dollars based on those Ether reserves. And then they went to multi-collateral DAI, which is now how it works. And then they end up with a ton of USDC and then some other junk, which is, you know, not even on the blockchain. So of course now it's very centralized and very exposed to like OFAC risk and stuff like that. So I guess they can go back, but the problem is you're gonna have the exact same problem that they had back then, which was it's hard to retain the peg at par when you have a difference in, you have an asset liability mismatch, and you're using, let's say, Ether as the base collateral for your dollar denominated liability. And then, you know, the question is, well, do you have a negative interest rate if you need to alter the peg? And nobody really wants a stablecoin with a negative interest rate. So, you know, if it trades above the peg. So then they went for the dollar based assets. Anyway, it's a pretty fascinating case study in sort of macroeconomics, I think. I don't know what's going to happen.
Well, the whole stablecoin industry, the way it is right now, is you sort of have Tether on one end, you have USDC on one end, on the other end, and then you have Maker kind of in between. And it's possible to me that within 5 years, Tether is going to be significantly marginalized from a regulatory perspective. I think the USDC model clearly works and will probably get codified into some sort of a bank charter. And then maybe DAI doesn't exist. Maybe, you know, you have this flurry of attempted algo stables on top of that. Maybe, who knows? It might be that on some of these crypto exchanges, Bitcoin and ETH become the base pair.
Yeah, I think we might go back to that. So it's kind of a push and pull. I've thought this would happen for a long time. You get very centralized with the stable coins taking over, and then you realize belatedly, oh, actually, that was exposed us to way too much risk. Let's go back to the, you know, commodity cryptocurrencies. as the main form of collateral and the main pairs. And I think that realization is happening. So I actually wouldn't be surprised to see the pendulum swing the other way.
It does bring some pretty complicated things for the derivatives platforms, though, because then you have if you can't margin in dollars, it just gets really ugly on the downswing, and so you're going to end up with these vicious death spirals on the COVID collapse day would be a good example. BitMEX just trending towards zero on the Bitcoin price, just because the collateral keeps on falling. Yeah,
the dollar-based collateral is better for sure. I will say that Tether has shown an interest in distinguishing themselves dramatically from other stablecoins, and that they refused to blacklist the OFAC addresses. They said they were waiting for law enforcement to give them a request, and they hadn't heard from them yet. So they didn't preemptively do it.
Same thing with Paxos, right?
Same with Paxos or BUSD. Yeah, so there's different schools of thought in stablecoin land over that, about preemptive regulation versus waiting to hear from a judge. So they're not all the exact same product.
Did you see this news out of Thailand so there was supposed to be a transaction? So SCB, the Bank of Siam, they were supposed to buy BitCup, which is an exchange, and they walked away from it a couple of weeks ago. It turns out that it looks like one of the reasons they walked away was that there was some insider trading there. So the Thai version of the SEC fined the CTO $235,000 for insider trading, and it was like a small amount of money that he was insider trading too. So $61,000 worth of fraud. It's like, way to mess up the transaction. What a dummy.
It's crazy that we keep seeing this, like, minuscule amounts compromising huge reputations or deals. The proceeds from insider trading are often minuscule. So we do have a bunch of content on the merge coming out. We interviewed a certain David Hoffman from our sister podcast, Bankless. Fun fact about Bankless, they got their idea for the weekly roll-up from this very show, the weekly Roundup. No hard feelings.
They've done a great job with it.
They're a much bigger show than us, so all credit due to them. So that is going to be dropping a day or two before the merge. And then also, in your merge-related content, we are going to welcome Kyle Waters from Coinmetrics onto the show to talk about Coinmetrics' merge report. So here we go. Here's our little sit down with Kyle. Well, Kyle Waters, welcome to the show. This is your first. We've had some Coinmetrics employees and adjacent folks on the show before, but this is your first time. So welcome.
Thanks, Nick. Yeah, happy to be here.
So you yourself and your colleagues have written a pretty mammoth report on what else? The merge. What motivated you to write about the merge?
Yeah, thanks. Yeah, so a lot of teams at Coinmetrics are working really hard right now in preparation for the merge. Really significant upgrade to Ethereum. And the research side of things, we are kind of hyper-focused on thinking about kind of the changes to how this impacts Ethereum security, economics, a lot of new analyses that have kind of derived from the merge. So just kind of in preparation for that and being kind of top of funnel for new metric ideation going forward. So keep a lookout for that.
So what is Coinmetrics' role in the merge? I mean, what have they done so far, and what potential influence could CM have here?
Yeah, so we've been running nodes on the Beacon chain. So kind of take a step back. So the Beacon chain is this parallel blockchain that's kind of orchestrating all of proof of stake on Ethereum post-merge. It's been running since it launched in December 2020, and we've been running nodes for it to collect data, to understand it. We've also been running test nets. So the Ethereum community and developers have been running these mock merges throughout 2022. They started with Ropsten, Sepolia, they went on Sepolia, then this Gurley a couple of weeks ago. We've been running nodes for these test nets to understand kind of what's going to happen and what to expect for how this impacts on-chain data.
And do you expect that it'll become materially harder to run the sort of like CM data collection infrastructure post merge? Is that something that we're worried about?
Yeah, it's a good question. So it actually does require a good amount of kind of new analysis, because now we're effectively running two clients instead of just one. So, you have people might have heard of the Geth or Go implementation of Ethereum, or some of these other client software implementations of the Ethereum protocol. So now we're running two of these. So we have to collect data from this beacon chain, or what we call the consensus layer, and then also the data on what the existing kind of infrastructure layer or execution layer of Ethereum, where users are making transactions and account balances. And to be clear, like none of that really changes. The interesting thing is that the designers of the merge have kind of created this to be very minimal impact to applications, and there's really no kind of need for users to touch anything or do anything. So there's very minimal impact, but from kind of under the hood, things are changing significantly.
And the analytics providers are going to have to reshuffle a lot of their metrics, presumably, and a bunch of new metrics are going to emerge, right?
Yeah, exactly. So a lot of minor metrics are going to be, essentially deprecated or go to zero. That's a very significant change. And then you kind of have this big changing of the guard with the main economic agent in the mix. And so now without miners, there's a whole new analysis around understanding validators and what their returns are, how effective they are, how performant they are. These are kind of all new metrics that are spinning out of a brand new set of economic agents who are in charge.
So the report's great, really nice visualizations. Let's talk about the distribution of stakers at present. So it's sort of highly inegalitarian, I would say, to put it euphemistically. You guys did some work to characterize who is staking and, ascribe addresses to these various entities. What are your chief findings from this?
Yeah, sure. So this is a really important question. So the kind of the breakdown of validators. So there are a few different ways to stake ETH right now. When designing the system, optimistically, Ethereum developers hoped that anyone can kind of be a solo staker, or run a node independently, because it's a lot easier than kind of procuring the infrastructure needed to run mining in proof of work. However, that kind of takes the right risk tolerance, kind of technical know-how. You also need 32 ETH, which is not an insignificant amount of money, like $50,000 give or take today. And so a lot of these like custodial staking services and staking pools have emerged to kind of accommodate these smaller ETH holders. And so what we found, and this has been talked about frequently, but like Lido, which is a liquid staking pool, has a significant share, about 31% of, and by far the largest, kind of contributor to staked ETH today. That's kind of one of the big cohorts. These are centralized exchanges. So, a lot of people hold their funds already with custodian exchanges, and then they just kind of will spin up validators, spinning up the nodes on behalf of these people who are depositing their funds with them. So Coinbase is the largest exchange there at about what we've estimated about 13% of the total staked ETH today, which is about 13.3 million total.
So you've been able to characterize about 2/3 of all the ETH deposits in the staking contract. Is that fair to say?
Yeah, give or take. I'd say about 2/3. And yeah, I would encourage everyone to kind of look at this pie chart. It's easier to visualize this than to hear it. But yeah, it's to kind of understand the difficulty of this problem. It requires tagging addresses on chain. So for some, it's very easy to know that for Lido, for example, it's just a smart contract on Ethereum. you can very easily kind of track the provenance of flows from Lido to the beacon chain. For others, a lot of other exchanges kind of go through these other entities go through kind of more steps to cover their footprints, kind of chiefly Coinbase. And so we needed to kind of understand patterns on chain to characterize funds that are coming from some of these exchanges. So that adds a degree of uncertainty, but we're very confident in what we have tagged here. And this is an area we're actively researching to kind of better characterize the total set of entities that are staking.
Certainly kicked off a big debate in the Ethereum community, the concentration of power here among major validators. So ETH issuance currently stands at just over 4.5%. It's expected to drop precipitously. Do we know exactly where it's going to stand post-merge?
Yeah, that's a good question. So right now, every day, about 13.5 thousand ETH is issued to miners via block rewards and these other kind of uncle rewards, which are kind of this other given to stale blocks as a security measure, composed of a much smaller portion of rewards. But that's kind of the setup with total issuance or inflation per day as it stands now in proof of work. With proof of stake, that issuance is going to be dropping to about 1.7 or about 1,700. So roughly about 90% reduction in rewards. So to the validators. And so when we take into account the ether that is burned, so with the introduction of this EIP 1559, which is this big overhaul to Ethereum's transaction fee market that took place last year, already at times Ethereum's issuance has been deflationary, but now kind of when this issuance is dropping so much, the burn will tilt in favor of deflation, very likely. And we're probably going to, so kind of on a total aggregate basis, we'll see inflation drop to about 0.5% at today's rate of staked ETH. And that's an important point. So the schedule is dynamic. It's dependent on the amount of staked ETH, goes up as more ETH is staked, but at a decreasing rate. And the issuance will probably be negative, depending on where fees or demand for block space, kind of how high that is from users. So that's varied a lot over time. We have one really interesting chart in the report, I think, that contextualizes this a bit more and shows what net ETH issuance would have been under kind of the current issuance schedule with the burn rates that we saw over the last year. Granted, Ethereum demand was very high. We had this kind of massive explosion of interest in NFTs and DeFi, and just kind of overall user demand was very high. And some of that's kind of come down a bit now. So it's very cyclical, but it gives you a sense of where we're going.
So basically, if you want to kind of forecast what returns from staking ETH will be, it's really multivariate, because there's the generic reward to stakers. There is also the function of your return differing based on the proportion of ETH that is staked or not. So the more ETH that's staked, the less you'd earn in terms of your share of that pool.
Right.
There's the usage of Ethereum and the accompanying burn, and I guess the tips to stakers, and there's also the presence of MEV, or not.
Yeah, exactly. There's a lot of moving parts, and kind of in practice, what you'll end up seeing and what you have seen. So an important point too is that the beacon chain, like I mentioned, has been running since December 2020. So we already do have some data on issuance. There's about 740,000 ETH has been issued on the beacon chain net since it launched. We already have some data on kind of what expected versus actual returns have been. So, there's also the other factor of getting penalized on the beacon chain. So you have to do your job right. Slashing. So We've seen some big staking services get slashed for being offline or making mistakes. And so this is kind of all these estimates are in under the best case scenario of performing your duties correctly. But in practice, things can go wrong. You can go offline. So that kind of forces you to have redundancy and really kind of think deeply about some of contingency plans if things don't go according to plan.
Yeah, so for a single staker, I know there's been a lot of emphasis on these sort of individual stakers as potentially part of Ethereum's immune system here if the large industrial stakers start to misbehave or filter their blocks to comply with various government dictates and so on. What is the share of kind of individual stakers that you were able to characterize that are doing the whole process themselves, kind of bare metal, as opposed to going through a third party?
Yeah, it's a good question. It's probably a pretty small portion based on what we've seen. We tried our best to categorize a what we called a hobbyist group. And what we did there is we just looked for any address that had deposited just the kind of bare minimum 32 ETH and no more than that. And then just label that as a hobbyist. It's also possible that you have some of these, or maybe early, they maybe participated in the Ethereum crowd sale, or they were just early adopters. They have, maybe they're whales, I guess that is a better way to describe them, and they've spun up maybe 10 or 20 validators, and they're doing it as a solo entity. We're not really capturing that in that categorization, but it is kind of about, I'd say, less than 5% of the share that we've captured. And I think part of the reason that is that, like we were saying, that there's a lot of variables when it comes to returns, and it's pretty difficult to kind of maintain hardware and software at a 24/7, 365 with consumer. I mean, it can be done with consumer grade hardware, performant consumer grade hardware, but there are definitely a lot of considerations that go into it. And if there are options to kind of stake with an expert, some of those incentives are pretty strong.
So we've had what some are describing as kind of a pre-merge rally, sold off a little bit recently. I know this is the same debate we had in Bitcoin about the halvings being priced in. Just speaking for yourself, what do you make? I mean, do you think that this, there's something the market isn't realizing in terms of pricing in the merge? Is there still optimism, or, are all these dynamics pretty much priced in by the market?
Yeah. So we actually did a really interesting piece on this in Say the Network last week, where we looked at the options market. So we partnered with Data Always, who's a pseudo-anonymous, really great pseudo-anonymous crypto data researcher. And, the market is accurately pricing in some of the risk, and we can see from the options market. And kind of expected volatility is going to probably peak around the merge before coming back down. At least that's what the market's pricing. So in terms of kind of how that feeds into spot, I think, kind of the same thing that you've talked about, that it's kind of an efficient market. If you understand the efficient markets hypothesis, issuance is kind of known, like where it's going. So that being said, we might see kind of some of the narratives around, especially around some of this like ESG narratives, really start to bring new users, get more kind of attention in the Ethereum ecosystem that could push fees up, base fees up on the network, start driving down issuance. So there could be a feedback loop there that maybe some people are not yet anticipating.
One thing that always struck me was the fact that the Ethereum leadership, or elites, or community, whatever you want to call them, the key stakeholders that make decisions in Ethereum, they installed a pro-cyclical monetary policy, which is kind of the opposite, I would say, of what orthodox monetary policy looks like, whereby, at least under the Keynesian model, whereby you meant to stimulate in a recession and a downturn to be countercyclical. In ETH land,
well, it kind of puts a penalty on you as a holder, right? If you're not doing, you get penalized as with more inflation if there's low activity.
Right. So it's in a time in like a bear market, there's more issuance.
Right.
And in theory, sort of the ETH price would sell off as a consequence, ceteris paribus. And then in bull markets, there's less issuance and there's more scarcity. In my view, that's pro-cyclical. I mean, it's actually, I think the Bitcoin miners operate in much the similar way, but I do have to chuckle a little bit at the fact that Ethereum ended up with this pro-cyclical monetary policy.
Yeah, no, it's definitely an interesting dynamic that happens, and I think if you're thinking about where, like we were saying, like where issuance will go, a huge one, I'd say the biggest indicator really is the demand side, and so predicting the demand side is really hard. The supply side's known pretty well. It's just where that new kind of bid will come from for block space is hard to predict. L2s are starting to kind of L2 activity and roll up activity is starting to compose a bigger percentage of kind of base layer block space, but that's one thing to keep an eye out on, and we talk about a little bit in the report.
Well, Kyle, keep it up. This is great. State of the Network, always one of my favorite weekly reads.
Yeah, thanks, Nick, and definitely keep a lookout too. We're going to be doing more reports and kind of as we approach the merge, more coverage. So excited to kind of get that out there to everyone.
Awesome. Thanks for joining us. Look forward to reading it.
All right, so I think that's it for the week. Football season's right around the corner. It's not this weekend. One more weekend of no football, but we're almost there.
So you went to do some scouting at the Patriots. What did you make of the team?
I'm feeling pretty good about it. Everyone's negative on the Patriots this year. I didn't know if you know that. Everyone's kind of wondering what's going on because Matt Patricia is the de facto offensive coordinator. He used to be the defensive coordinator. But I thought they looked pretty good. I'm thinking like 16-1, 15-2 type of season. So
the biggest news in Washington football is we have a new name. We are no longer nameless. So we're the Commanders. That's really it as far as excitement goes. Yeah, I actually liked the Washington football team more. I thought it was really funny having the generic name. Now that we're named, it's just less exciting.
Yeah, I don't know. I mean, I think the best you guys can hope for is like maybe have a Monday night game, but I don't really see it being that exciting of a year.
We get the NFC East is always way overrepresented in prime time, and they're always terrible. So, but you notice like they always put NFC East teams in the primetime slots.
We've just been so spoiled with having Brady and all the championships in Boston that they were always on Sunday night, Monday night. When I was growing up and Bledsoe was a quarterback, they were almost never on Monday Night Football. So we'll be talking a lot more football this fall, especially if the bear market continues.
And we have an episode for you Tuesday actually. Monday is a holiday, on Endstate, our favorite Web3 merchandise footwear brand.
Excited for that one. All right, everyone, have a safe and healthy weekend.